Hello and welcome to this video. In this video I'm going to provide a brief summary of the Operational Risks Lecture 8 where we talk about operational sources, and we actually go on to mention some of the kind of management areas or reasons why to manage this risk. The measurements will be addressed in another lecture. So as I've mentioned, we're looking at kind of the main sources of operational risk, looking at a few historical examples, and kind of moving forward how it could be managed. So where does this risk come from? Now in this banking risk series, we've covered the likes of credit risk, market risk, interest rate risk, and liquidity risk so far. But then what else is there? You could argue everything else is linked to operational risk. And within the risk I've just noted, operational risk is inherent throughout. So examples, historically, there's a lot of market risk examples, or kind of issues that have happened in the market, which have then subsequently resulted in another risk or collapse. And that could be from operational risk. So at the top here, we have kind of a power line failure for the NASDAQ. Now obviously that will cause a bit of havoc when it comes to trading shares, but why was that caused? Well, it was caused because squirrels eating electrical lines. So that's a really out there operational risk. So that operational risk of kind of an infrastructure issue could lead to issues for market risk. In the second example, we had a bank collapse in the form of bearings. Now one would argue that was it Nick Leeson that brought the bank down? Or was it the Kobe earthquake? Or was it the subsequent impact on the value of the Japanese yen? So you had the Japanese yen collapse because of an earthquake, which you could argue is market risk. But the operational risk involved was Nick Leeson was able to control front office and back office in the bank, and he was able to commit fraud. So there's kind of some market events which were exploited from a fraudulent point of view to cause the bank collapse. So it's kind of you can see there's like a string of a series of events that took place, but ultimately underpinning it was Nick Leeson had access to front and back office and minimal management checks, which all falls into operational risk. And then during the financial crisis, of course, there's a lot of argument to say it was all about credit default swaps, the housing market, and all that, which we've covered many times before. But underpinning all this was people. There was banks telling their front office to sell. There were people pushing through these products. So these pressures and the people and their irrational behaviour, or the lack of control by management, all falls under the likes of operational risk. So as I've noted, we've covered market, credit and interest rate risk. But operational risk is everything else: strategic, reputational, business risk, model risk. If you look at the Basel Accords, when we work out capital requirements need to be held for credit risk, market risk, and operational risk, which the measurement models cover in a later lecture. So always remember there's got to be something external or internal that could be the cause of operational risk, where it leads from a market risk or credit risk failing can result in or could be amplified by operational risk. So how does the BIS define this? Well, there is no real definition. You could just argue that it's anything external or internal that could cause another risk to be amplified. Any failing, any system failing, any management control, any reputational damage, this is all encapsulated under operational risk. So it's a really broad concept. The BIS have tried to link it to kind of technical, human, and external. And then further to that, they've included 7 different loss types, which you can see from this table. So you have like some internal fraud, where this could be employees or management. External fraud, so this could be their customers, cyber hacks linked to fraud. We have employment and practice, even health and safety. This is all operational risk, because if there's a health and safety failing in the business, then this could cause losses from being sued. There's other issues like client and product, and like some money laundering. Money laundering obviously is regulated heavily in many countries, and the likes of the money laundering officer is potentially liable to be put in prison if money laundering is found within a bank. There's also the likes of damage to physical assets, which can arise from many different things, such as natural disasters, earthquakes, terrorism, war. So that's a very broad thing, but really that's about your buildings. Your buildings can be damaged, or your computer systems could be damaged. There's also business and system failure, which is obviously becoming more and more important as we evolve in society, becoming more online. And then lastly, there's the kind of execution, delivery, and process management. Again, it's really important, certainly from a technology point of view and data protection point of view. So in your work, you can obviously provide this table as an example of the sources of operational risk from BIS, but it would be more useful if you'd add like an extra column to give examples from your bank or so on. Just like this example. So this is from previous students' work. They've looked at the 7 loss types as listed in this table, and they've went through Barclays' example to kind of show where this risk may arise. Now they used the annual report, but for the likes of operational risk, what we find with banks' annual reports is they don't really elaborate that much, if at all. They normally keep it to a bare minimum. They normally explain the kind of policies and procedures they have in place to prevent operational risk, but they don't really talk about specific cases unless it's a large case. For instance, in Barclays we had the LIBOR rigging scandal. They would have acknowledged this because it was widely known. But other than that, you will have to use the likes of media sources to kind of look for these examples of operational risk from these areas in your bank. What I've done here is I have access to some data. So there is an organisation. The links are in the summary pages, where you can actually access data that's been collected of how often these risks occur. So this is a table of kind of frequency numbers. So obviously what you can see, the highest number really reflects in the kind of retail banking, where you have the likes of external fraud, client issues like money laundering, and obviously delivery and execution. So what you can see here is the retail banking sector really can face the most operational risk. But if we look at the number of kind of events, they're quite high. But if we translate that into financial loss, then we can see the likes of external fraud really has a kind of extreme amount of nominal loss as well. So have a look at these 2 tables to get an idea of kind of the significance in terms of quantity and then nominal value of loss. And this data has been taken from a 5-year time horizon. If you look at the most up-to-date data that I could access, you can see how the likes of operational risk events have changed in terms of frequency and nominal around the world. Now, interesting, if you look at North America, the frequency between 2018 and 2017 actually dropped. but the scale increased slightly. So even though the amounts of operational loss events happened, lowered, the kind of financial cost actually went up. So these are obviously events that, or losses that may be more high impact. So it's not always about quantity. It's always about like quantity of events. It's always about kind of impact. If there's lots of small little events, then that's going to have a low impact, which we'll get into later. But if you have like one big event but a low probability, that can also be quite severe. So let's just talk about right now. We have the likes of the COVID-19 around the world. Now the probability of that ever happening is extremely low, but the impact on society and potentially the banks later on might be quite significant. In the Saunders and Cornett book regarding the sources of operational risk, they've kind of merged the 7 from BIS into these 5. Now, okay, so obviously you can use this textbook as a reference, but as I noted before, if you're going to do something like this, your examples, make them a bit more realistic, provide examples, give specific examples in places. Here's just a list of the kind of losses from the big banks throughout history, and you can see some of the sizes of these losses, particularly the ones that are committed by internal fraudulent events during the crisis. So likes of Jerome here from Sierra General, and obviously our trader here at UBS, quite significant losses. So if you are interested in this, something you're really interested in, here's a list of all the kind of different cases where there was kind of lack of control or management pressure, which allowed certain traders or certain departments to kind of take advantage and either create gains for themselves in the form of bonuses and rewards, but at the same time committing fraud or kind of profit smoothing, so management didn't actually know what was fully going on. Now I noted earlier on that from a Basel point of view, they want you to look at the risk-weighted assets from an operational risk point of view. So what I've done on Bloomberg here is kind of pulled some data on the operational risk-weighted assets. Now, what I'd highly recommend is look in the BIS document or kind of do a search on what constitutes a risk-weighted asset from an operational risk point of view. Now you might see here, well, actually, it looks like HSBC really have a high level of risk-weighted assets compared to the rest of the UK banks. But if I kind of divide it by the total assets of the bank, so to kind of make a bit more of a fairer comparison, what you can see here is they're all pretty similar given the size of the bank and the operational risk they face. And what you'll notice is how they've kind of converged together. Now this is not by accident, but this might be the way that risk-weighted assets, operational risk, is actually calculated. Because prior to 2017, where you can see it's quite volatile, this is where everybody could use the advanced techniques to calculate the capital charge for operational risk, which is covered in the next lecture. But post 2017, really the BIS turned around and said, the advanced techniques are good, however we don't really want you to use them, and move towards something that's called the business indicator. This is because the advanced techniques that were used prior to 2017 were kind of like black box. They were very advanced, but we didn't actually know what they are. So you had the basic approach, the standardized approach, and advanced technique, but everyone that was using the advanced technique were either able to make it too complex that the regulators couldn't understand, thus reducing their capital requirements, or it led to this kind of different spread between different banks. If the banks use different models, as you can see, the variation between banks here prior to 2007 is quite high, but as you got past 2007, you can see how the risk-weighted assets kind of converge, which suggests that everyone using the business indicator is kind of showing that convergence and kind of being more of a fair comparison than banks using their own models in the advanced techniques beforehand. From a example point of view, the likes of the Pillar 3 disclosure reports do kind of show you the total amount of operational risk losses per bank. So if you want to do it for your bank, do have a look in the Pillar 3 disclosure report, because you're going to get more information than you would if you looked at the annual report. Now, I have covered a lot about the kind of 7 different loss types demonstrated by the BIS, but on an annual basis, Risk.net provide the top 10 operational risks facing the banks moving forward from that year or into the next. And what you'll see here really is a heavy link to kind of IT. Even though we're seeing in the data from 2013 to 2018, the biggest kind of frequency related to kind of fraud and theft, which is number 5 on this list. But moving forward, there's a lot to do with IT. So there's 1, 2, 3, 4, 5, at least 5 there linking to IT. Of course, they're going to have things like regulatory risks or change from regulators, that being a risk on banks because if the regulators add extra capital requirements or they change how you implement regulation, this is going to be a cost to the bank. They might have to put systems in place or change the way they do business, which is a risk the banks could face. So really moving forward, there's quite a lot of nervousness regarding risk arising from external threats to the computer systems. In Bloomberg, we can actually get data on cases against organizations, and in research, sometimes when we look at operational risk, we use kind of the number or frequency or severity of legal cases as a proxy for operational risk. The logic behind that is the more legal cases you face, obviously means the likelihood of operational risk in your bank is higher. You wouldn't be getting sued if you hadn't done anything wrong. There's no way of looking at it. But what you can see here in numbers, so number of cases here, you've got Barclays at the top there, but obviously the number of cases against its peers, you can see a size of the likes of Bank of America. Now obviously the caveat here being that in the American legal system, the likelihood of being sued is much higher than in the likes of the UK. What we can see here is broken down. So this is an example of Barclays, kind of where the likes of the kind of legislative cases against Barclays actually arise from over the last 10 years. And quite a lot, so this blue at the bottom, relinks to consumer credit. So this is kind of customers. During this period, this is antitrust. Now, if you look at what antitrust means, that's really an American term for kind of competition. So there is a lot of issues potentially regarding competition, if they've like a failed merger and acquisition, or if they have kind of overstepped the mark when it comes to competition law. And in 2012 there you can see a high level of issues regarding kind of securities. So this might be something to do with the back end of the financial crisis. Quite a lot of cases arising from the mis-selling of some interesting and exotic securities the customers didn't understand. But this is just an example of what you can get from Bloomberg. Now the function for this is LC. Looking away from the kind of Basel definitions now, we have some definitions here from Hamilton Micklesfate 2006, if I've pronounced that correctly. In their book, they talk about how businesses may fail. And here's some examples that they break it down to. So the first one is kind of strategic failure. Now, strategic failure can arise from the management kind of set up their strategy for the banks to operate in, but they really don't understand the area they're working in or foresee future change. So it's a strategic issue for Northern Rock. It's kind of like stack it high, sell it cheap. They were kind of looking at selling high risk mortgages in the assumption that house prices would go up. So this was obviously a strategic decision to offer these products. And also the amount of mortgage products they were doing was trying to entice new customers to kind of grow. So it's kind of strategic failings. Overexpansion is the biggest kind of cause. So this is really where, again, like Northern Rock and other building societies that demutualised and became banks in the UK, when they were able to do this, they really expanded rapidly, taking on advertising different products from their main business model and growing substantially. But really, when the crisis hit, they took too much risk. The likes of Washington Mutual, they were the kind of the Walmart of the banking sector in the US, is what the CEO said. And they were really rapid expansion, and they sell to try and grow their business, which ultimately was part of their downfall. Also, there is kind of like issues from dominant executives, the people at the top, the risk appetite the top suggest, and the kind of overall management and the potentially overconfidence and not understanding the sector is another reason. For instance, Adam Applegarth at the top of Northern Rock that originally came from Walmart. He was from the supermarket sector but took over a bank. So kind of that, his dominance and his strategy obviously could be very short-sighted. And they also have control failings. Obviously this is loads of examples of this. So Barron's Bank, when Nick Leeson was able to commit fraud on a massive scale, there was control failings. He had both back office and front office. There was no segregation of duties. He asked for more money. The management in the UK just sent it across to Japan without questioning it because he was making lots of money. So there's quite a lot of control issues. One would argue that the likes of the internal auditors should be able to pick this up, or the risk management in the bank should pick this up. But during the financial crisis, these weren't being picked up because management were waiving warnings due to profitability. So quite a lot of operational issues really do arise from failure in the control systems or process and procedure. So as I said in another lecture, we cover the kind of measurement techniques, but of course we can try and model operational risk from a point of how often does it happen and how much is it going to cost. Do we try and minimize this from happening versus the opportunity cost? If something happens very often but has kind of a low impact, is it worth spending lots of money to prevent this risk from happening? So kind of when we look to model operational risk, we need to take into account kind of frequency and severity. Here's just a diagram that might kind of give you an idea of the kind of what may cause operational risk in the first place, the type of events, as you can see that's the 7 outlined by Basel, and if these happen, what does that actually mean, kind of from a consequence point of view. So obviously like poor training for staff, management turned blind eyes, poor IT systems, which quite a lot of the banks, like legacy banks, actually have at the minute, where they kind of just bolt on new packages, new software, new updates, and like during the cracks of where they bolt these things onto the core system, this is where kind of fraud or the hackers get in. So kind of all these causes can lead to these certain events. And what are the consequences? Obviously, besides financial loss, you have the likes of reputational damage. The reputational damage of some of the banks during the financial crisis, you can't put monetary value on that. From a UK point of view, the biggest winner of the financial crisis was the likes of Nationwide Building Society. Everyone took their money out of traditional banks and went to building societies that are owned by its members, not shareholders. If we look at this backwards, what we can see is we can have a look at what actually happened, the risk, calculate the losses, how they were caused, and then think, now, what should we do to prevent this happening again? So look at what actually took place, what was the impact, what caused it, now what can we do from a kind of training or cost base to prevent this from ever happening again. And in your work, certainly in the likes of the fraud risk framework you might go on to do, this is what we want you to look at. What risks took place? Why did it happen? What did the bank learn? What did the regulators learn? What was the implication? What was the costs of trying to rectify this issue? And what procedures do they now have? So as I just noted before, it's a game of trade-off, cost-benefit analysis. What's the likelihood of this happening? What's the severity? Shall we control for it? If we control for it, how much is it going to cost us? What do we physically have to do? A typical risk assessment is here on the left, but the Basel like to use the kind of one over on the right. For instance, a high likelihood and high impact, number 9 on a typical risk assessment. What is that? What kind of thing would have a high likelihood and a high impact? Things that happen most often and have a high impact. Now, these things are quite difficult to example. That's why the Basel prefer the kind of things that are high impact but low likelihood, just like the COVID-19 incident right now. That's why they prefer that over the typical risk assessment, because if you're a bank and you're in an area or a location where you have high likelihood and high impact, often, why would you be there? Why would you have the business there? This is why the likes of the bank, the BIS, prefer to have the one on the right, which is more relevant for the banking sector. Looking towards management, obviously, when you've kind of seen what's gone in the past, you think, now, how can we prevent this from ever happening again? So obviously staff training, reviewing policies, then you have the likes of loss control. So if the event is going to happen, so if we've got, that's probably something in like the orange section, what do we have in place to kind of as a backup? for instance, COVID-19 at university, the backup is good online teaching. So in a bank, do you have, if your IT system goes down, do you have a backup system? If you have a power cut, the backup generator, that sort of thing. We also have the insurance sector. So insure for catastrophic events. Buildings, typically they're insured for capital loss. Business being forced to close because of regulation or kind of by the central government. Some insurance companies pay out for that. So there's that. And lastly, from BIS point of view, obviously your reserves, your capital reserves. How much can you take a hit from operational risk? So you have to have capital requirements based on the risk-weighted assets to absorb any shocks. Have a look at this effective management diagram. So obviously you've got, as management and quality controls go up, kind of how does that impact economic profit? So obviously if you go for like high management controls over here, but the more you do, potentially, is that going to cost you a business quite a lot? So if you're kind of over cautious, you really have to do a cost benefit analysis to say, if you have really high management controls, quality, what does that do to economic profits? So have a look at that diagram. Additional reading for this, obviously we can have a look at in the Blackboard site, the Prima case studies. Quite a lot of them are underpinned by operational risk losses. Have a look at the National Australia Bank case study, that's really good. Specific to operational risk rather than it being a kind of subsidiary. Obviously textbooks, got a range of chapters there. For your work, I would highly recommend that you look at your bank's Pillar 3 disclosure report when it comes to operational risk. And also, following that, have a look at the media sources, search your bank, search operational risk deal in your bank, and get a number of examples you can incorporate to your work. Thank you very much for watching this video.